Just a few months ago, the legendary Michael Burry, who predicted the stock market crash in 2008, took a short position against the American stock exchanges, with over $1.6 billion invested. Even after closing his position and accepting the loss, he made another bet, this time against the semiconductor market, precisely when the entire world relies on this market and supports the sector. Recently, I have seen some people talking about a possible recession scenario, even a potential stock market crash. It's no wonder Michael Burry made this risky investment against the market. There are many reasons why it's believed that the stock market might enter a recession in 2024. I'll present 3 strong indicators to you, which suggest more than mere speculation. With a little internet research, you'll discover that some investors and analysts have been talking for some time about the market being on a constant rise, and that in this state, there will eventually be a market correction. This is especially true when considering the entire economic and even geopolitical scenario contributing to this affirmation.
The yield curve has inverted for the first time since 2006. And we're talking about specifically the gap between the 5-year Treasury note and the 30-year Treasury bond.
It's interesting to note that this indicator has been present near recessions, and currently, it's no different.
Now, as we turn to this big move to try and rein in skyrocketing inflation, Federal Reserve expecting to announce the biggest rate hike in decades, a dramatic effort to slow the economy. And here to tell us what it means for our money.
When the Fed raises rates, the point is to try to slow the economy. It means it's more expensive to borrow money. But here's what's tricky. If they raise rates too much too quickly, then that could tip us into recession because it'll be hard for businesses.
This is one of the strongest indicators, as we almost immediately see its consequences. It's notable that there have been drastic changes in this indicator compared to a few years ago. Despite signs of a possible recession, it's important to emphasize the need for prudence and caution in taking any action in this scenario. The main reason is not to induce fear or alarm people, but to prepare you to react and not be caught off guard, because the signs are there for everyone to see. I count on your opinion in the comments to debate this subject, and if you have any ideas, doubts, or suggestions for a video, I'll be grateful if you share them with me.